In the first part, Vishal covered the investment strategy and approach towards the end. In the second part, let's get practical. How do you actually structure your portfolio? We have 6 model portfolios designed for different type of investors, and I think this will really help put things into perspective.
Absolutely. The key to match your portfolio to your risk appetite. Not everyone is comfortable with the same level of volatility, and that's perfectly fine. Let's walk through each one.
Let's start with aggressive portfolio. This is designed for investors who are ready to take higher risk and can stay calm when markets get turbulent. If your goal is to maximize long-term returns and you can handle the ups and downs along the way, this one's for you.
In this portfolio, 40% goes deep into large cap funds, Nippon India Large Cap Fund and ICICI Prudential Large Cap Fund. Large caps form the foundation because they offer stability even in an aggressive portfolio.
Then 15% is allocated to mid-caps through White Oak Capital Mid-Cap Fund and Edelweiss Mid-Cap Fund. Mid-caps offer that growth kicker companies that are established but still have significant room to expand.
Small caps get 10% of the allocation. Bandhan Small Cap Fund and Nippon India Small Cap Fund. These are higher risk, higher reward bets. They can be volatile, but over long periods, quality small caps can deliver exceptional returns.
25% goes into flexi-cap funds, HDFC Flexi-Cap Fund and Parag Parikh Flexi-Cap Fund. Flexi-caps give fund managers the freedom to move across markets capitalization based on where they see opportunities.
And finally, 10% is allocated to thematic funds, ICICI Prudential Manufacturing Fund and Mirae Asset Great Consumer Fund. These tap into specific growth stories like India's manufacturing push and rising consumer spending.
So, to summarize the aggressive portfolio, 40% large cap, 15% mid cap, 10% small cap, 25% flexi cap, and 10% thematic. It's equity heavy and growth oriented.
Now let's talk about the moderate portfolio. This is for investors who can take average risks and want returns better than a fixed deposit over a longer term, even if short-term performance sometimes disappoints.
The moderate portfolio still has a significant equity component, but it adds debt and precious metals for balance. Large cap remains at 40% with Nippon India and ICICI Prudential Large Cap.
Large and mid-cap funds at 10%, HDFC Large and Mid-Cap Fund and Bandhan Large and Mid-Cap Fund. These funds give you mid-cap exposure but with a large cap cushion.
Here's where it gets interesting. 10% goes into Balanced Advantage Funds, HDFC Balanced Advantage Fund and ICICI Prudential Balanced Advantage Fund. These funds dynamically manage equity and debt allocation based on market valuations. When markets are expensive, they reduce equity. When markets are cheap, they increase it.
A significant 30% is allocated to debt, specifically corporate bond and short duration funds like Kotak Corporate Bond Fund and Mirae Asset Short Duration Fund. This provides stability and regular income while equity does the heavy lifting for growth.
And 10% goes into gold and silver through Mirae Asset Gold ETF or Fund of Fund and ICICI Prudential Silver ETF or Fund of Fund. As we discussed earlier, precious metals act as a hedge against uncertainty. Now, for those who are more risk-averse, we have this conservative portfolio. This is for investors who get uneasy when things don't go as planned and prioritize capital protection over aggressive growth.
In the conservative portfolio, debt takes center stage. 70% is allocated to corporate bond and short duration funds, Aditya Birla Sun Life Corporate Bond Fund, ICICI Prudential Corporate Bond Fund, Mirae Asset Short Duration Fund, and HDFC Short Term Fund.
Only 20% goes into equities, and even that is through Balanced Advantage Funds, which, as we mentioned, automatically manage risk. The remaining 10% is in gold and silver for diversification.
The objective here is simple. Try to get returns slightly better than a fixed deposit on a post-tax basis without taking significant risk. It's ideal for investors closer to their financial goals or those who simply prefer peace of mind.
Now let's talk about a specialized portfolio, the regular income basket. This is designed for investors who have a lump sum to invest and want regular cash flows from their investments.
70% of this basket goes into the Balance Advantage funds, ICICI Prudential and HDFC Balance Advantage. These funds are well suited for generating regular income because they manage downside risk while participating in equity growth.
The remaining 30% goes into multi-asset allocation funds, Vito Capital Multi-Asset Allocation Fund and SBI Multi-Asset Allocation Fund. These funds invest across equity, debt, and gold, providing built-in diversification.
The recommended approach here is to set up a systematic withdrawal plan or SWP of around 6 to 7% per annum. Alternatively, you can opt for the dividend option to receive periodic payouts. This way, your capital stays invested while you receive regular income.
And for those who believe strongly in India's growth story and are willing to take concentrated bets, there's the Build India basket.
This is a high conviction and high risk portfolio. 80% goes into thematic and sectorial funds, Tata India Consumer Fund, Mirae Asset Great Consumer Fund, and ICICI Prudential Manufacturing Fund. These tap directly into India's consumption and manufacturing growth themes.
The remaining 20% is in flexi-cap and multi-cap funds, ICICI Prudential Multi-Cap Fund and Parag Parikh Flexi-Cap Fund, to provide some diversification beyond the thematic bets.
This basket is not for everyone. It requires a strong belief in specific sectors and the patience to ride out volatility. But for those who want to participate aggressively in India's structural growth story, it's an option worth considering.
Finally, for high net worth investors with more than 5 crore rupees to invest, there's a modified aggressive portfolio that includes alternative investments.
Large caps get 30%, mid caps 10%, small caps 10%. Flexi cap and focus funds together get 20%, including Parag Parikh Flexi Cap Fund and Old Bridge Focus Equity. Thematic funds get 10%.
20% is allocated to PMS, Portfolio Management Services, and AIFs, Alternative Investment Funds. These are sophisticated investment vehicles that offer strategies not available in regular mutual funds.
PMS and AIF options include listed equity strategies, private equity investments ranging from early stage to growth stage companies, private debt, and real estate focused investments. The specific choice depends on your individual risk profile and investment preferences. So, there you have it, a complete framework of model portfolios ranging from aggressive to conservative, plus specialized baskets for regular income, thematic investing, and high net worth investors.
The key takeaway is this: pick the portfolio that matches your risk appetite and financial goals. Don't chase returns by taking more risk than you're comfortable with. And remember, these are model portfolios. You can always customize based on your specific situation.
One more thing, within each category, the recommendation is to split your allocation between the suggested funds rather than putting everything in one fund. Diversification within the categories also helps to manage risk.
Let's wrap up with the key takeaways. January was a challenging month for markets, but the underlying developments are constructive for India's long-term growth.
Absolutely agreed. Sharbari, what's more, the India-EU Free Trade Agreement opens massive export opportunities. The India-US trade deal removes tariff uncertainty. And this year's budget stays focused on productivity and fiscal discipline while aligning with global technology trends. What's the message for investors, Sharbari?
For investors, the message is clear. Use this period of volatility to build your portfolio systematically. Diversify across large caps, mid caps, and small caps. Keep a small allocation to gold and silver as a hedge.
Markets go through cycles. What matters is staying invested with a sound strategy and not letting short-term noise distract you from long-term goals.
Well put, Vishal.
According to my risk appetite, conservative portfolio fits for me.
Oh, the aggressive portfolio with alternative investment looks interesting to me, Vishal. Comment down below your preferred model portfolio.
If you found this helpful, do share it with someone who's navigating their investment journey. We'll see you in the next one.
Mutual fund investments are subject to market risk. Read all scheme and related documents carefully before investing.